evening, Trade Flair family. Welcome back to the Nightly Breakdown, where we break down what happened today in the stock market, as well as give you an idea of what we're looking at into tomorrow. Now, before we head over to conduct a technical analysis of the SPY and 5 stocks, let's look at some key points to get a broader view of where we stand. So for the first key point, I want to talk about China and how they're declaring growth. And to understand this, we need to understand that the US and China are the two largest economies in the whole world. And historically, when one is experiencing a period of growth, the other is experiencing a period of tightening. Now, before the pandemic, China was experiencing a period of growth while we were experiencing a period of tightening. The pandemic obviously messed that all up because both economies needed support from their central banks to bring back the economy, bring back jobs. Now, as far as GDP, recently China and the US rebounded to pre-pandemic levels, but because of weakening exports, surging producer price inflation, and the continued crackdown on the property market, China is starting to see problems with sustaining economic growth. Now, as far as understanding these periods of growth and periods of tightening, if you don't understand interest rates, understand that when interest rates are low, economies are said to be in a period of growth, and when interest rates are high, then economies are said to be in a period of tightening. Now you can see here the Chinese benchmark interest rate has not moved since 2015, and instead they have used their reserve requirement ratio to adjust rates during the pandemic. Now, one thing I want to point out here is when in 2015, when China stopped cutting rates, the US was experiencing a period of growth with rates close to zero. A few weeks after China stopped cutting, which began the period of growth, we saw the US get to tightening. So China cut rates down, and as soon as they stopped cutting and held them at a steady rate, the US began a rate hike, which sparked Chinese growth in late 2015 and early 2016. Now, understanding this, let's think about the move that China just made by lowering the reserve requirement ratio. And this is basically a pseudo rate cut and kind of implies a declaration of Chinese growth, or the fact that they need more Chinese growth. Especially while the US sees inflation, this is kind of signaling to me that the US economy may lean back towards tightening, while the Chinese continue to use monetary easing to spurt liquidity and create growth in their economy. This means that we are in for a rate hike, and we should look to China as the leading indicator. This brings me to my next key point, which is going to be the data that we will get this week. Investors are really looking forward to the CPI data on Wednesday, as well as more jobless claims Thursday and retail and consumer sentiment on Friday. With everything I said about China declaring growth, I'm definitely watching macro indicators in any of these comments from or about the Fed talking about tapering. I'm also looking at the data that could cause the Fed to start tapering. We're getting big inflation data this week on Tuesday, and we're also expecting the same amount of inflation to keep coming in hot, and the market will likely react if we see any surprises. We've seen the spike in inflation because we saw supply chain disruptions and a labor shortage, all during a surge in consumer demand from the stimulus and vaccine. So this is what's causing the rise in prices. The Fed has maintained its view that prices will be rising at this rate only in the short term, and the inflation rate is transitory. They have been consistent with their commitment to the economic recovery. The Fed holds a dual mandate. They are focused on the economy through the lens of qualitative maximum employment and stable prices. Powell has continued to use the benchmark of 2% average inflation as the line in the sand. We have not yet exceeded 2% average inflation, and in 2010, when the Fed was doing quantitative easing to spur recovery from 2008, they had this 2% inflation set, and they never exceeded it. The key to inflation right now is the labor shortage and the supply chain reboot. We see jobs coming back, but we are not seeing them come back at the rate that we want them to. In 2015, when the Fed had determined maximum employment, the unemployment rate was around 5%. This is when they hiked rates and they sparked a tightening economy in the US. At the same time, the Chinese entered a period of economic growth by lowering their interest rates to the floor. As far as the CPI data, I don't think this one will change the Fed's mind, but it could change the narrative of the market. If it looks like we will stay under 2% year on year, growth will be able to rally with lower interest rates and no rush to raise them. If we see speeding up towards our 2% target, then we could see more rotation into value and defensive stocks and a little bit of sell-off in those growth names. Investors are predicting more moderate returns for the second half of the year, so that's something to keep in mind. I also really want to watch the jobs data come in because more jobs could point towards less inflation. At the same time, jobs will tell us a lot about the recovery. As far as the unemployment rate, we were at 3.5% before the pandemic, the lowest unemployment rate since the 1950s. I'm looking at 5% because that's where the Fed determined max employment in 2015 and started hiking rates. So I think the Fed's really going to notice that 5% level, and I think that's where we'll start to see more talks about tapering when we start to get close to that 5% level. Looking at our bonds, it looks like yields are going to get a bounce. After seeing the bounce, we kind of got an idea of what was causing this move in yields. It looked like rising yields in the first quarter were a function of increasing inflation worries, and as soon as we started to get fear of a global recovery being derailed by variants, we started to see yields pull back. So something to keep in mind as we head into next week and into the rest of the year. Headed over to our last key point, which is as always our indices and our sectors. And on Friday, the Dow was the leading indice, the SPY was right behind, and the Nasdaq trailed. We saw small caps up with the emerging markets as well. As far as our sectors went, we had financials leading with energy, materials, and industrials. On the downside, we had utilities, healthcare, and consumer staples. Everything closed green. We had a broader market bounce on Friday after everything seeming a little bit shaky on Thursday. So now that we have a broader idea of where we stand, let's head over to do a technical analysis of the SPY ETF, which tracks the S&P 500 index. And looking at the SPY, looking at the weekly, we have a hammer candle at all-time highs, and this can be looked at as a hanging man, which is bearish, or it can be interpreted for its lower wick. The green close says a lot, telling us buyers were present towards the end of the week. Now looking at the daily, this candle should not be taken lightly. There is no upper wick, it's got a long body, and it has volume towards a upper support. At this point, it looks like we have a lot of strength in the S&P 500 right now, but I wouldn't be surprised to see a down day on Monday so this thing can recharge and go up to more all-time highs. Overall, I'm not bearish as this thing stands. I wouldn't short this thing just based on price action. But I do have my levels in mind just in case we do see some downside. Now that we have an idea where our SPY sits, let's head over to the watch list, starting off with Airbnb. Looking at Airbnb, we had a great day on Friday. We've recently been trading in this range pattern here. We first looked below and went, doubled the range, found support, ran back into the range, and now we're looking at the half back of the range for a break for a possible fill to 154 at the top of the range. On the break at the top of the range, we could be potentially targeting a double of this range here, so I'll be looking for a quick fill up to 161.14. So definitely keeping my eye on Airbnb. Seeing this move on Friday is very interesting. Next up on the watch list is Snapchat, and we wanted to short the hell out of this thing on Friday, and that's why I want to go long on this thing now, because a lot of shorts got squeezed. We covered this on Friday because we saw the possibility of a break to the bottom of this range, but instead we saw a huge rush of volume and buyers to buy that dip. Shorts covered, and now I'm looking for the break of 66.76 for a quick fill all the way up to $70. Definitely keep your eye out for Snapchat. I would not be happy if I shorted this thing, so keep your eye out for Snap. Next up on the watch list is Overstock, and looking at the daily, we have a huge green continuation pattern supported by volume and a bullish divergence on the MACD. Also notice here I have a bullish channel continuation pattern drawn that is drawing out really nicely. We saw a lot of volume off of this support with a huge move, and I expect this thing to keep running to the top of this channel and potentially even break through 100 like we saw in February. Definitely keeping my eye on Overstock. They had killer earnings last quarter. I think there's going to be a lot more hype for theirs this quarter. Overstock's also related to crypto, so I like this play, especially if crypto is bouncing right now. Next up on the watch list is Honeywell, and I think Honeywell is a solid value name that will outperform in a tightening US economy. Looking at the daily, we have a poor structure above 225, and we just printed a green continuation candle through the 50-day moving average, so I'm looking to take a play on the break of 225. Also looking to add more money to my long-term position, as we could see more value stocks outperform, so definitely keeping my eye on Honeywell, especially as we head into this week. Next up is Bank of America, and like I said, I like the banks here, and I think they will continue to dominate. As far as price action goes, we have a double bottom here. I would like to play the break into the upper third of this pattern. That would give me some conviction that buyers will likely take this thing up to the neckline for a test. at $42 and possibly a break up to $45. So definitely keeping my eye on Bank of America, looking to grab some in the money calls with some time. And don't forget that Buffett and Big Money are going deep on Bank of America. Just something to keep in mind that can maybe add some more conviction to the name. Tonight's nightly breakdown. If you enjoyed the video, if you gained value, or if you learned something, make sure you hit the like button and don't forget to subscribe so you can get notified whenever we post any live or educational content. If you're looking to join our team and be surrounded and motivated by our online community of traders and investors, as well as gain access to trade signals that let you know whenever we make a trade, check out the link in the description below to join our Discord, gain full access by upgrading to TradeFlare Pro, get half off your first month using the discount code TFPRO2021. But don't be mistaken, we are not financial advisors and none of this is a recommendation. The stock market is risky and you could lose money, so use the information inside these videos at your sole discretion. And as always, you cannot forget that time is your most valuable asset, so quit wasting it. Get up, get out, and go get it, my friend.